It was a misty morning in Mumbai when Ananya first woke up with a peculiar excitement in her heart. For days now, she had been reading about the stock market, particularly the bustling world of trading in India. She had always been curious about how people made money in the market, how fortunes were created and lost, and what it took to really understand the game. Trading, as she had read, was not just about buying and selling stocks, but about making informed decisions, understanding market movements, and embracing a bit of risk. But the real question wasn't whether Ananya was excited, it was whether she was ready. India, with its rapid economic growth and emerging middle class, has long been a fertile ground for traders. The Bombay Stock Exchange, BSE, and National Stock Exchange, NSE, the two largest stock exchanges in the country, provide the stage for millions of investors, from seasoned traders to newcomers like Ananya, to test their mettle. "I'll start small," Ananya thought as she poured herself a cup of coffee. But how? Before diving headfirst into trading, she knew there was much she had to understand. Trading, she realized, was akin to navigating through a dense jungle. You needed a map, knowledge of the terrain, and most importantly, survival tools. And the stock market, like any wild forest, could be unpredictable, dangerous, and rewarding all at once. As Ananya settled down with her notebook, she began to list the reasons why people were so drawn to the Indian stock market. The advantages seemed compelling. India's economy was growing at an unprecedented rate, fueled by a young workforce, an expanding technology sector, and increasing foreign investment. The stock market was a reflection of this growth. Many of India's biggest companies, Reliance, TCS, Infosys, were global powerhouses, and their stock prices were rising alongside their profits. Investing in Indian companies, Ananya realized, was not just about buying shares. It was about participating in the nation's growth story. Historically, Indian stocks had provided higher returns compared to other forms of investments, like fixed deposits or gold. Ananya recalled reading a study that showed how, over the past decade, the Sensex, India's benchmark index, had outperformed other investment options. The opportunity to grow wealth over time, even from a modest starting point, was one of the stock market's biggest draws. The Indian market wasn't just about large-cap companies. There were mid-cap and small-cap stocks, sectors ranging from technology and finance to pharmaceuticals and agriculture. The diversity of companies listed on the BSE and NSE meant that investors could create portfolios tailored to their risk tolerance and financial goals. One of the major advantages of trading in India was the ease of access to the market. With a growing number of online trading platforms and mobile apps, anyone with a smartphone and internet connection could start trading. No need to walk into a bank or call a broker. Trades could be executed in seconds from anywhere in the country. But as she listed these advantages, Ananya's mind wandered to the other side of the coin. What were the risks? The pitfalls? Ananya had heard stories of people who lost their life savings in a day, of stocks crashing unexpectedly, of scams and volatility that wiped out entire portfolios. Trading wasn't all rainbows and profits. There were real risks involved, and she needed to be aware of them. The Indian stock market was infamous for its volatility. Prices could swing dramatically in a single trading session due to various factors: political instability, global economic events, or even corporate scandals. While volatility could lead to significant profits, it could also lead to catastrophic losses if trades weren't carefully managed. Trading, Ananya read, was as much a psychological game as it was a financial one. The temptation to make hasty decisions, like selling when prices dip or buying during a bull market frenzy, often led to emotional rather than rational trades. Fear and greed, she realized, were two of the most dangerous emotions for a trader. One of the biggest mistakes new traders make is diving into the market without sufficient knowledge. It was easy to buy stocks on a whim or follow tips from friends, but without conducting proper research or understanding a company's fundamentals, these decisions could lead to significant losses. Every trade came with a cost: brokerage fees, transaction charges, and taxes like the Securities Transaction Tax, STT. While these might seem small on individual trades, they could add up over time, especially for frequent traders. As Ananya continued her research, she realized that the risks could be mitigated with the right approach. Trading was like any other skill. It could be learned, honed, and mastered over time. But before stepping into the market, there were some precautions she needed to take. Knowledge was the first and most crucial step. Ananya decided to enroll in a stock market course and started reading books by renowned traders. She discovered terms like fundamental analysis, which involves studying a company's financial health, profit margins, and growth potential, and technical analysis, which focused on chart patterns, historical price movements, and trading volumes. She also familiarized herself with different types of trading: intraday trading, where stocks were bought and sold within the same day, and swing trading, where trades were held for several days or weeks to capitalize on market trends. The key, she learned, was to know what kind of trader she wanted to be and which strategies aligned with her financial goals. Before diving into the real market, Ananya signed up for a demo trading account. Many online platforms provided this feature, allowing new traders to practice with virtual money. It was like a flight simulator for trading. No real risk, but plenty of learning opportunities. Ananya sat down one evening and carefully assessed her financial situation. How much could she afford to invest without jeopardizing her essential savings? What was her risk appetite? Was she willing to take big risks for the chance of big rewards, or did she prefer slow and steady growth? She decided to start with a small portion of her savings, treating it as an experiment. She set clear goals, a modest 10 to 15% return over the next year. More importantly, she also defined her exit strategy. If she ever lost more than 10% of her initial investment, she would stop and reassess her strategy. Never put all your eggs in one basket. This piece of advice rang in Ananya's ears as she began selecting stocks to invest in. She made sure to diversify her portfolio across various sectors: technology, healthcare, and banking. This way, if one sector underperformed, her entire portfolio wouldn't be affected. This was going to be the hardest part, Ananya realized. Trading was thrilling. It was easy to get swept up in the excitement of market highs and panic during lows. But she had read enough stories to know that emotional decisions often led to poor outcomes. One of the strategies she decided to employ was using stop-loss orders. These automatic triggers would sell her stocks if they dropped to a certain price, protecting her from larger losses. This helped remove some of the emotional decision-making from the process. The stock market didn't exist in a vacuum. Global events, government policies, corporate earnings reports, all of these factors could influence stock prices. Ananya made it a point to stay updated with business news, government announcements, and economic reports. She subscribed to financial news portals, attended webinars, and followed market analysts on social media. Months of preparation later, Ananya was finally ready. With a clear head and a calm heart, she logged into her trading platform one crisp morning. She had researched a few companies and decided to buy shares in a mid-cap IT company that had shown steady growth over the past 5 years. Click. Her first trade was placed. It wasn't long before she began to see the stock's price fluctuate. It rose slightly, then fell, then rose again. Ananya's heart raced, but she reminded herself that this was normal. She had researched the company thoroughly and believed in its long-term potential. Over the next few weeks, Ananya watched as her portfolio grew, albeit slowly. The market had its ups and downs, but she was learning to stay patient. More importantly, she was learning to trust her research and her strategy. As the months went by, Ananya made more trades. Some were successful, while others taught her valuable lessons. She learned to embrace both her gains and her losses, realizing that trading was not about getting every decision right, but about making more informed choices over time. She also realized that the stock market was not a get-rich-quick scheme. It required time, patience, and a willingness to continuously learn. But for those who were willing to put in the effort, the rewards, both financial and intellectual, were immense. Ananya's journey into the Indian stock market had just begun, but she was already starting to see the potential for long-term wealth.